Hey, folks. Let's see how long it takes to get to. Yeah, not long. You hear the old man. All right. How you guys doing? You having a good day? So obviously, the market's found its footing. So we're gonna take a quick look at a couple things real quick, and then I'll send you on your way. Promise I won't keep you long tonight. I promise. I promise. 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 So the market traded down into 30% of last week's weekly range, which is TGIF, and found its footing and ran off pretty strongly. Um, if we're looking at the continuous contract, and again, you can see that because there's an absence of any month in the name or the title of the chart. These are relative equal highs. I like 26,399 half. Just be mindful of this high as well. So that one here, 26,112. Have that also on your radar. But watch what happens when we hit the adjustment. Okay, watch. It's higher targets, okay? That's why I'm using this one, because it's closer to where we are by the market price. So if we use just this high here, it's 26,562 3/4. You want to have that level as well. And then finally, the all-time high back here with it adjusted, 26,859 even. Okay, so those are my key levels going, looking for continuous higher prices. If we follow through, if we keep going higher, those are the levels I'm watching, right? So that makes it very simple, very easy. So everything is as it was without the adjustment on. We're going to go down to a 1 minute chart. Okay. And a lot of you asked for this review here. I know most of you don't need it, but I'm just tossing it in there real quick. So obviously the market was rallying pretty strong today and yesterday. And we entered into a time when the lunch session starts at 11:30 and ends at 1:30. The lunch macro can occur slightly earlier. Okay, and it can begin around the 10:30 hour. Why? Because it's the first hour's dealing range. Once the first full hour rather is complete, the first 60 minutes of trading, many times you'll see that it can create a intermediate term higher low of the day, or it could create the higher low of the day. Think in terms of like when we traded just primarily forex between 10 o'clock and 11 o'clock. That's your London close time frame. So split that in half, you got 10:30. So 10:30 first hours range, first dealing range or first hour dealing range for trading is done from 9:30 to 10:30 Eastern time. Once that's fulfilled, then we could start looking for reasons to anticipate some measure of a pullback and a retracement. That's what lunch macro is. It's a pulling back or a retracement back inside of whatever the range has been since the 9:30 opening. All right, so let's encapsulate that in the chart so that we can see it. So there's a 9:30 candle there. The opens at 25,656 quarter. And from that candle, we rallied up until we get to 10:30. I'll annotate that vertically. There's that. Okay. So at 10:30, it can begin the lunch macro. It can start doing it. Like that's the earliest it can do it. But you still have something have you have to have something rather technical to spur it on. So by looking at where we have seen the 10:30 hour, or 10:30, half the hour of 10 o'clock to 11 o'clock, that's when the macro can start. So in other words, it can start running lower back to a low that formed at 10 o'clock. So at 10 o'clock, right? So we have this low, it can aim for this low, this low, and this low. Once it took out this minor buy side here, once it did this, look at the time it's occurring. You're going to blend several things here now. The market's been going one direction from the open at 9:30. It's wildly bullish. It's been bullish for 7 days nonstop in deference to where it opened and where it closed. So closing higher on the day, 7 days in a row. It's covered an enormous amount of handles. So it's very, very stretched out. And now we're entering a time when the macro can happen at 10:30. We took out a minor buy side here. So we need a higher high on the day. But now we're inside the macro time. So here's 10:50 to 11:10. That magnet set on strong. It's killing me. So let's do it like this. 10:50. Wow, it's shooting in there strong. Okay, we're not gonna mess with that at all. Let's do it like this. Vertical line, 10:50, and then we will do 11:10. Okay, so there's your macro time. It took buy side. What's the macro? The lunch macro? It's a retracement inside of the range. From 9:30, it's moved up. Starting at 10 o'clock, if we're going to look for a failure swing, running buy side during the macro time, it needs to show a willingness to want to go lower and start seeking sell side. That would be trailed behind a low here, a low here. It could go there, it could go there. But since it's extremely strong, very strong type movement higher, the likelihood of it seeing coming all the way back down to this low, that would mean something if it went through all this consolidation. So it would take a lot to get through that. Here, we have this low, and we have a buy side imbalance, sell side inefficiency. So inside this buy side imbalance, sell side inefficiency, to the left of that, what do we have? That wick. So I'm going to take these vertical lines off. Just know that this portion of price action is what we're aiming to focus in on. I apologize. I thought I hit the record button. The whole time I was doing the trade, actually, it was I was on the assumption that I was recording it. I was talking the whole time. Well, not the whole time. I put the mute on a few times. I went over there and I got water in the bowl for the girls, and then I grabbed something out of the refrigerator, and then I came over and sat down and turned the mic on and said, "Okay, yeah, I'm going to add more." And so we went into the inversion fair value gap, and it was a little disconcerting because when I realized it wasn't recording, it's one of those things where if you ever recorded or if you ever live streamed, if you ever did any kind of video work, it's very it's deflating because while I didn't say much, what I did say obviously made sense at the time. So for someone that was brand new, it would have helped them. It wasn't very wordy like I've been in the live streams, but this wick and this gap. So if there's a buy side imbalance, sell side efficiency, it's the gap that takes precedence. So if the gap's low as here at this candlestick's open, that's about as low as it could reasonably reach for if it was going to do it. Worst case scenario. Ideally, you want to see it trade to or just above consequent encroachment. To that midpoint, to the candlestick's high or the wick high, that's your sensitive price point. So while we do have that gap here from this candlestick's high and this candlestick's low, this candle right there is your buy side of balance, sell side inefficiency. sell side would rest right below that low and reaching into that midpoint level of this wick. Okay. So that's the target. So that was my maximum objective for the macro. And then I was looking for a portion of the trade here. Buy side taken here. Notice that this is green up here. See that? Now I'm just going to go real quick right over to MES to show you something. Okay, we're looking at a different market, and we're going to go back to MNQ. None of this is changing from live price action data feed to market replay. All right, so that way we know what we're seeing here isn't some tomfoolery. It's not some garbage sim stuff. All right, so we have all the information here on the chart now. And while price was utilizing this buy side and balance sell side efficiency, as I've been teaching, very easy, high probability inversion fair value gaps. The easiest ones I have, the ones that just are just so obvious that you're never going to really miss it. That's what you want in your trading. You want something that's high caliber, that's very specific, it's very precise. You want it to be there in an obvious manner. So if someone was to ask you, where's the obvious fair value gap that you could anticipate trading? Well, it's the first one that forms. But now I've taught you a higher tier understanding where it may not be the actual fair value gap if there's a wick to the left of it. That range is going to be more specific. And you'll use, when it's bearish, you'll use the lower half of the wick, low of the wick up to consequent encroachment. That'll be your actual first presentation for a fair value gap because we're treating the wick as a gap. Well, when I was teaching the aspects of inversion fair value gap, obviously everybody went ham and started thinking every fair value gap can become an inversion fair value gap, and that's not true. Okay, so when we have a high and we anticipate first by time, macro time between these two vertical lines. Okay, so I'm going to take those lines off. Now we've accomplished the method there. So we know inside that range of time, it can form. What specifically? The lunch macro. What is its default? It runs to sell side. It's defined by time, going back to 10 o'clock. So from 10 o'clock, from where we create the potential setup or the origin of it, the inception of the move going lower, start looking back for the lows, this one and this one. Okay. So because it's a very strong market, that's why I lent my focus only to this. If it would have been part of a bearish market condition, then obviously I would have looked for much lower. I would have looked for the lowest low that formed right after 10 o'clock. Okay. So that's what that's the process and protocol I follow. When we're in a bullish move or a bullish buy program, when the market's likely to continue going higher, I'm only looking for one or two short-term lows that have been trailed up for anyone that's long. So they would have moved their stop loss up here from earlier in the session. And as the market went higher and created this low and started to trade higher, the stop losses would have been moved from here and migrated to below this low here. Okay. So now when price took that buy side here and ran above it, I'm actually looking to go short there. I'm going in there with the intentions that this is probably going to be a intermediate term high intraday, and it's likely to then run for the macro. Now, I want you to think about what I just said. It sounds like a whole bunch of gobbledygook for someone that's brand new. Okay, it sounds like word salad. But for the folks that's been here for a while, you've heard me talk and teach and showcase and actually do these things now. And again, showing you with a live execution. The market goes above this buy side here, runs above it, turtle soup, not Linda Rasch's and Larry Connor's from Street Smart's book. Okay. You should buy the book. It's a wonderful book, but when you open and read it, you'll see that I'm not teaching that stuff. None of that stuff is in my repertoire. Okay. The idea of a false breakout, that book in 1995 helped me understand that. That's where I got the first real understanding of a false breakout. I never seen it explained in a way that was so simple, very cut and dry. And then I started looking for things based on that. So if you don't have the book Street Smarts, Linda Rash has blocked me on X, and I think it's because I have so many clones online that she probably blocked me, and there it is. And that's fine. It's not imperative, okay? But as a female, most men wouldn't like to admit that that was a mentor, but that she was a mentor to me in the early stages in the first couple years of my trading. That book was very impactful. But her Turtle Soup or Turtle Soup Plus One with Larry Connors in that book has nothing to do with what I'm teaching and how I'm trading. There's a very specific rule-based idea. I'm not going to tell you what it is because you can pretty much Google it really. But I think the book overall is still good. It's a little pricey, but it's still good. And so the idea of running above this high here, that false break, I'm expecting this to now pull back because this was not enough of a retracement. Why wasn't this enough of a retracement? Why wouldn't I have expected this? I know, man, he read my mind again. How are you doing this? The amazing Kreskin, right? So we had the higher high here, and then look at where it pulls back. Did this drop down to take out that low? No, no. So this isn't enough of a criteria. But now when it ran back up, then to take that high out, then yes, we went to premium. Premium pulled back and it didn't validate by having this run here because it could have came down, hit that, went up, and then maybe set the stage for a lower low, as I was indicating that lower low right after 10 o'clock. I would have aimed for that one then if it would have did what I'm explaining here. But because it didn't do that, I wanted to see price run up in here, overtake this sell side imbalance, buy side inefficiency. I wanted to see it overtake that entirely and take out that high. And that run above there, that is not in Street Smart's book. Okay. It's very simplistic the way they teach it in that book. But I facetiously used the term turtle soup because when I was on Baby Pips, I was teaching and I wanted to have something that everybody, because I was really pushing that book for Linda and Larry back then because I still think it's relevant. I think it's good. It's very simplistic. There's a lot of things that I don't like. Like there's a lot of indicator based stuff. I don't like that stuff. But the generic things like stop hunt, single, low, and all that business, I like that. And it helped me when I was beginning. So using this context here, running above that high at a time when it should pull back, and the direction is determined because of the macro. It's going to pull back into the range that formed since 9:30 to present time. So it's been going higher, right? So where do we look at as a target if we're selling short above that high there? What's that low right there? That's your range from high to low. So your dealing range is this portion of price action right here. And it would be external range liquidity that you'd be targeting. And then you would aim for this low, which would be another form of external range liquidity from this original high, the origin of it, down to that low. This is the dealing range for that. And trading below this into the consequent encouragement of this wick, targeting that right there, that is external range liquidity in deference to this dealing range. Okay. So if it's a little confusing for you and you're brand new and you're getting caught up and confused by the terms, trust me, it's very, very easy once you spend a little bit of time. Okay. Go through the lecture notes and the teachings that I have on the YouTube channel, and you'll see what I mean by that. All we're doing is looking for obvious pools of liquidity that supposedly don't have any effect on trading. So I don't know what to tell you. It seems to be working. It happens a lot in my hands. I'm not sure why it ain't working for everybody else, but I guess it's one of those things, right? So the market drops aggressively into this buy side imbalance, sell side inefficiency that forms. Watch, it forms right before this high is taken out by this candlestick. So your eye should, by default, over time, it'll start doing this. It'll jump right to that because this is the only inefficiency right before this high is taken. So it's not complex. It's not complicated. It's not ambiguous. It's very specific and it can't hide from you. That's what makes this superior to everything else. because it's visually represented in the candlesticks. There's no guessing. There's no, let me think about this. Which candlestick should I use? It just jumps off the chart at you. And that's what your model should do. You should start looking for things in price action that yield that type of characteristic. If it isn't obvious, it's probably not there in price action. You're probably going to force a trade that probably isn't there. Okay. So we have time. We have the macro that's likely to unfold. We have another higher high, which ran here. And now we also have this buy side and balance, sell side efficiency that is perfect for a potential inversion fair value gap. Because it's an up close candle, we would view this as, if it was still continuously bullish, if it dropped back down into it, that would be interpreted as a potential discount fair value gap that we can go long in. In this case, we want to see it wilt and go through it. We really want to see it go through this. We do not want to see any kind of discount sensitivity. That means the upper half needs to give way. Does it do it? Yes. Now, because it trades outside of it on a closing basis, when we trade back up into it, it needs to stay out of the upper half with the bodies. You can see it trade to the midpoint, which is consequent encroachment, that dotted line. That's permissible. The bodies ideally stay in the lower half. More optimal conditions are when the bodies are outside of it, even though it wicks into it. And it does it 2 times here. You see that? Now, this up close candle, in the recording I thought I was having, but it wasn't recording, and I apologize. The idea of that open price, when it tried to go up there, when we trade back down through it, that activates this candlestick as a order block, a bearish order block. So it's the full range, but that price, when it trades up into it here, we can utilize that, and that could be an entry mechanism. It could be a pyramiding point, and then the market drops aggressively and takes out the first target there, and then accelerates through that and takes out the sell side there and trades right into consequent encroachment of that wick right there. Now, when price dove through here, it was given 2 perfect scenarios or signatures that are algorithmic. We first have to cancel the approach of interpreting this as a bullish fair value gap. If this model is, as I'm outlining here, if it's true and everything is on point, the drop down into this candle upper portion here, it needs to give up the ghost. It needs to go through it. It should not go down and start rallying up. Okay? Notice it's not doing that. We go into it, we wick here, give it another chance, another candle, opens, trades up a little bit, trades in the volume of bounce that I don't have annotated there. It drops inside the upper portion of that gap. And then the next one, we open up, touch the high of it, and one little tick outside of it, and then crushes real sharp. And then we go into then looking at how it needs to use premium sensitivity, which is when we're looking for something bearish, it needs to stay out of the upper half and only use the lower half. And then it accelerates to the downside. So again, no market replay up here, okay? No market replay. As price was running up into it, I was trying to hit it as it was getting that. A little bit of heat on it. The next one here, same thing. Trying to key off of when we're close to that price level there, using market orders, not limit orders. I could have done better with the entries on limiting, but I didn't have any concern about getting all that perfect about it. I just wanted to make sure I got in it. And then here, same thing. We're trading up into the inversion fair value gap in the lower half, part of the bearish order block there. So I went short 10, 10 more. And these are micros. So right now, that would be the equivalent of 2 minis, which isn't all that significant. And then adding 10 more here, which is now is the equivalent to 3 minis. Okay. And then once we went below this low here, watch right here. You'll see what the exit is there for 10 of them. And in the final 10, right there at that low. And I didn't want to fancy dance. I was going to try to do it right at the consequent encroachment of that wick plus 1 tick, but I was afraid that the liquidity wouldn't match up with my exit. And then it would have been like this. It went there by price, but wouldn't let me out, and then I'd have to get something out up here that would bother me. So I just made it obvious and say I'm just going to go right at the low, right there. You can see it. So that's that. So that's the lunch macro as I taught it, and you can see the logic is still there. It's not cherry picking. It's not form fitting. It's not trying to make some new logic with it. I'm using the same parameters all the time. Okay, and I've seen a couple people say, "I thought lunch begins at 11:30." Yeah, lunch time is 11:30 to 1:30 Eastern time. But I taught that the macro can start pulling back into the range earlier, and it can happen as early as 10:30. And that's simply me dividing the 10 o'clock to 11 o'clock hour in half and respecting the same type of thing that we had for Forex when we were trading, looking for the London close time frame. So between 10 o'clock and 11 o'clock, that's the profit taking time of day. Same scenario, same type of thing, because that's what this is. We're looking for the lunch macro to afford you an opportunity to participate in a retracement when this would inspire people to kind of like squeeze them out and force them to take their profits because they're going to think it's reversing. And many times on bullish days, all this does is creates a new buying opportunity. Okay. And if you follow me on X, you've probably seen one of my students, FX Finesse or something. I may be mispronouncing it. He's actually a private mentorship student. And he actually went long in here. After I closed my short, he went long. So again, that's a testimony to how the students can take my concepts and apply them individually. You have a unique model. You're not piggybacking on me. You're not needing to take a signal from me. You're able to find your own setups and find your own way in all this. So it's very, very encouraging as a mentor to see that type of stuff. And obviously, the rest of the day, it just starts leaving and heading north still, and just kept on going higher and higher and higher in the day. We had a little bit of retracement in here. And now we're right at the 26,000 mark again. So I guess in a way where we've already shown where the upside objectives still reside by using the daily chart, just be mindful that during the live stream tomorrow, I'll be looking for something to support the idea. If we don't trade to them overnight, obviously, if we trade to them, um, I don't know what target I'll have to use. I'll have to look at the morning session, like 7 o'clock, and I'll tweet some things I'm watching, and then we'll go live again at 25 minutes after 9 Eastern time AM tomorrow, and I'll hang out with you until like 10:10, and we'll close it. So hopefully this has been insightful to you. Hopefully it's inspiring you to continue studying the concepts I'm giving you away. And until I talk to you then, be safe.